Another amazing week in the markets. The Dow Jones Industrial Average breaks 22,000 for the first time. In case you might have missed that, President Trump brought it to our attention with a video on Facebook. So this marks the 9th year of this amazing bull market that arose out of the financial crisis in 2009. Lots of people on Wall Street, including our guest today, Jim Glassman, think we can go higher. We don't mean to be the ones that always throw cold water, but we do want to stay sober, so we're going to bring you a couple of things that you might want to keep an eye on. First, a wonderful new advertisement was debuted in June. Have a look and see if you can guess what services are being advertised. This ad concludes with the message that the, quote, dumbest guy in high school just got a boat. And yes, it is brought to you by an online trading firm. This certainly recalls the days of exuberance in 2000 when there were a lot of ads like this, late 1990s, the big party, investing is fun, investing is easy, the dumbest guy in high school has this awesome boat that he can jump around on and dance on. Let us hope that it continues to be that easy, but often signs like this and euphoria like this is at least a sign that we are getting nearer to the top. And from a much more serious and analytical perspective, valuations also are sounding warning alarms. Valuations, as we've talked about on this show, are almost useless as a near-term market indicator. Stocks can always get more expensive or cheaper, so they don't tell you what's going to happen next. But if you look at this chart from John Hussman of the Hussman Funds, what you see is that many different measures of valuation, and they're all plotted on the same line here, are now reaching very close to the levels that they reached in 2000. And again, after the 2000 bubble and in the late 1990s, people look back and said, oh my God, how could it have been so crazy that we got to those valuations and everybody didn't know that their alarms were sounding? The answer was, at the time, the valuations seemed justifiable on a lot of measures, and the market had been super expensive for 4, 5, 6 years, and everybody had gotten used to it. So we are in a similar position now, where the market is extraordinarily expensive. There are some good explanations for that, starting with the idea that things have changed. The old valuation measures don't matter so much anymore. And lots of people believe that despite valuations, stocks can go a lot higher. But in the past, valuation has been a very good indicator of long-term returns. And usually, when you have valuations as extended as we are now, what you have is relatively crappy returns for the decade that follows. So again, we certainly hope that the party continues, but we would be remiss if we did not point out where the market is and temper our expectations for those long-term returns.